what I'm going to cover for maybe the next 45 minutes or so is rental versus trading income, rental income calculations, deductions, the surcharge, transfer property in a group, trading accommodation, trading income and accommodation, so hotels, B&B, Airbnb. Obviously, it's quite topical at the moment in the context of, say, some Ukrainians who are here because of being displaced, accommodation versus letting, mortgage in possession, chargeable gains, and then just to touch briefly on retirement relief and a couple of things like that. Sorry, I just need to move to the next slide. So rental income calculation, rent is the aggregate of the surpluses and deficiencies from properties. Surplus or deficiency for each property is calculated by deducting from the gross rent receivable, rent payable in respect to the property rates. This is all under Section 97. Expenses under the letting agreement, non-capital maintenance, repairs, insurance, and management expenses. This is just a brief recap on some of what Alan would have covered the last day. Interest on money borrowed to acquire, improve, or repair the property. Just to pause on that for a second, a couple of points to note there, I suppose, is the interest limitation rules that came in Finance Act 2021, and they're not in effect yet, but they will be in effect from next year, so they might make things a little bit complicated. And it's only for 2022, or accounting periods beginning on or after 1 January 2022. That's the reason why, I suppose, in a corporate context of what we're talking about today, that was the real reason why there was a change for the treatment of non-resident companies with Irish rental properties. Alan obviously covered the IRF and the REITs earlier, but if you just have a so-called plain vanilla corporate that's non-resident, that used to be bizarrely 20% income tax and either a Form 11 or a Form 1, but that was changed in the last Finance Act to they're now on CT1, and a 25% corporation tax rate applies, and that apparently was driven by that ILR. So that's an important change for anyone who has non-resident companies with Irish rental property. Property must be registered with the RTB to get a deduction. That's obviously only a residential property. And then there's just a simple example there just showing how it works. And again, that's just a recap of what Alan covered the last day.